Coming up next, Amy Finkelstein is not only a professor at MIT, she's co-author of a new book from Yale Press, Risky Business: Why Insurance Markets Fail and What to Do About It. The more you understand about just the basics of how insurance works, the better insurance decisions you're going to make. Cool thing I like about Amy is she's fantastic at telling stories that get the point across about how to think about insurance. Well, if you don't understand insurance, you are not alone. Some brilliant people don't understand insurance, and that's actually the crux of why my guest here joins me today. Amy Finkelstein joins me. How are you?
Thanks for having me, Joe. I appreciate being here.
Well, thanks for talking insurance with me, because as a fellow insurance nerd, I loved your project. I love the book, and it shines this light in an area where people get afraid. But the whole reason you started this project, and tell me if this is true, it's because some very high flying, very well-known individuals may not have known that much about how insurance compares to broccoli. Is that the story?
Yes. In fact, we jokingly thought, so our book is titled Risky Business, but we jokingly referred to it the three of us, I wrote it with my colleagues, Laurent Inev and Ray Fisman. Why is insurance different from broccoli? It was the alternative working title for the book. So the story of this goes back to the 2012 Supreme Court case over whether the Obama mandate that everyone have health insurance was constitutional. Now, we're not legal scholars or constitutional scholars, but from an economics point of view, because we're all economists, the reason for the mandate is precisely what our book is about, that why sometimes insurance markets won't work without, if we just let the free market run rampant. But we were struck when Supreme Court Justice Antonin Scalia asked during oral arguments, well, if a government can mandate that everyone have health insurance, can they also mandate that everyone eat their broccoli? Now, he was obviously making a rhetorical point about a, paternalistic and invasive, state that is meddling too much in individuals' lives. But for us as, self-proclaimed, as you said it, insurance nerds, this just made us hit the roof. I mean, insurance is very different from broccoli, even if people tend to dislike both of them. And the reason is fundamental to understanding all kinds of frustrations and mysteries about the world around you, like why dental insurance is so crummy, why pet health insurance is so expensive, why when you apply for auto insurance, they want to know about your credit score and your grades. And the reason is the following. Insurance companies care very much about who their customers are, because the company's profits depend not just on how much insurance they sell, but on who they sell it to. If they sell it to accident-prone, risky customers or safe and careful customers. By contrast, the supermarket does not care who buys its broccoli. They care only about how much broccoli they sell.
That is kind of the aha when it comes to insurance, Amy, I think, is that the customer really matters, to your point. But hey, buy as much broccoli as you want at the grocery store. That's great. But if you're the wrong customer to an insurance company, there's a ton on the line. You shine a light on this right at the beginning with a non-insurance story, because this is all about something you call in the book selection. And I think that is short for who selects your product and who's using your product.
Exactly.
But you tell a story about American Airlines. You mind diving into this? Because I think this is going to illuminate it for our stacker community.
Happy to do so. And that's because while selection is not a problem in broccoli, it's not a unique problem to insurance markets. Insurance markets are a particularly important example where it's a problem, but selection problems show up any time when a company's profits depend on not just how many customers buy their product, but which customers. And so we start with this story from American Airlines from the early 1980s, where they had the idea of marketing a lifetime pass of first class travel to, their high-end customers. Think about it, when you can go to an amusement park, you can either pay per ride or you can buy a pass that gets you a wristband so you can ride as many rides as you want all day long for free. So they thought of doing the same thing for first class travel. And they priced it initially at about, I think, $250,000, which in today's money would be about $750,000. So it's really, it's really a high end thing. And they thought this would attract some, rich pleasure travelers, and they'd make a ton of money on it in the same way an amusement park can make money by selling these, all day wristbands. And that's not what happened. What happened was the customers who bought it were the kinds of customers who just love to fly. So, one guy, for example, made 16 round trip first class flights from Chicago to London in the space of, I can't remember if it was like a month or a year, but a really short amount of time. Suffice it to, and that alone would have been like, $125,000. So, a substantial chunk of what he'd already paid. And that was just in the first few, beginning of his lifetime pass, as it were. Suffice it to say, the American Airlines quickly discovered that they were losing money on this, all you can fly wristband, because the people who were buying it were people who were using it on, just a gazillion flights and flying all the time, kind of like we talk in the book, up in the George Clooney up in the air character, just constantly flying. So they did what seemed to make sense to do when you're selling a product and losing money. They raised the price to make more money. But that, unfortunately, in selection markets is exactly the wrong strategy, because what happens when you raise the price? Well, take all those like really, really, high intensity flyers who were buying the lifetime pass, it's gonna discourage the least flying of all those high flyers. And then, so the only customers who continued buying it were even more extreme in the amount they flew. So the cost per customer were just going up and up, and they raised it again. And finally, after a few years, they threw in the towel and admitted defeat and canceled the policy.
It's so interesting because, if you raise the price on me and I love to fly, I'm going to make damn sure that I get my money's worth, Amy.
Yeah,
like, or if I don't double down,
or if I don't think I'm going to get my money's worth, I just don't buy I won't buy it. It's only worth it if you look at it and you think, wow, that's an expensive $250,000, but boy, do I love to fly, and boy, will I use it a lot.
I love this because it really shines a light on insurance and why they need to know their customers so much and why they ask reams and reams of questions. I remember back when I was a financial planner, and I know they've done a better job of looking at which information they need and what information they don't need, and which information, frankly, they can get from other sources with my permission. But I remember just pages and pages and pages of questions I'd have to ask a client if they wanted to apply for a life insurance policy. You make this statement really well about Harvard with 2 tiers of health insurance later in the book. They have a less expensive tier for people, and then a more expensive tier, but one that gives you a lot better benefit. And it seems like they went into the death spiral for the same reason. Can you tell the Harvard story?
Oh, sure. It's always fun to tell to make fun of Harvard.
Somebody working right across the street, it might be.
Exactly. As an MIT professor, it's always wonderful when mighty Harvard stumbles. And I actually have a bit of a personal connection to the story. So the way we know about this Harvard death spiral is because someone who was then an undergraduate at Harvard, Sarah Reber, discovered it for her senior thesis, and then ended up co-authoring a paper on it with her advisor, David Cutler. I met Sarah Reber after she had done this work, and we were roommates in graduate school together. And I introduced her to her husband, which, marriage markets are another selection market, but this one luckily did not have a death spiral. So this Harvard story is near and dear to my heart. So let me explain what Sarah and David discovered for us. So basically, as you said, Harvard, like many employers, offers a range of insurance products, so a less generous and a more generous one. And at some point in the mid 1990s, they were concerned about, Harvard, of course, has a huge endowment, but nonetheless, they're always concerned about their bottom line. And in this case, they were concerned that they were losing money on some of their benefits, like health insurance. And so they did something which I think actually seems totally sensible, which is to say, look, the employer pays for your health insurance, but we're going to pay, rather than pay, for either to pay for most of the more generous policy, we're just going to pay for the basic policy. And if you want a more generous policy, you're going to need to pay for it yourself out of pocket, which makes sense.
Which seems to, it totally makes sense.
Yes, it totally makes sense. They can give everyone higher wages, and some people are going to want to spend it on, trips around the world, American Airlines passes and whatnot, and some people want more health insurance. So let people decide. The problem was when they went to making people having to pay actually most of the cost of the more expensive policy, guess what happened? People who were younger, healthier, not prone to major illness were less likely to buy the more generous coverage. And so as a result, the average cost, the sort of number of doctor's visits, hospital visits of people buying that more generous coverage went up. So they had, just like American Airlines, Harvard had to raise its prices the next year on this more generous policy to cover its claims. Guess what happened? The healthiest of the customers who were buying the most generous policy stopped buying it. And there we went, round and round we went. And after a couple of years, like American Airlines, Harvard had to stop offering that policy altogether. And I want to emphasize something important. You might say, why does it matter if only, the really sick people are buying, the comprehensive health insurance? Let people, buy what they want. As we say in the book, we don't buy, none of the three of us buy expensive cars, and we don't consider that a market failure. But the issue is that the point of insurance is to protect you against the vagaries and uncertainties and vicissitudes in life. And those can happen even to healthy, customers, or, in the case of automobile insurance, safe drivers. The whole point of insurance is that it's about the risk, the what if. And all of us, no matter how healthy we think we are or how good a driver we think we are, can end up, sick or in an accident. And so we all want insurance. The problem is we don't want to pay for it, when it's priced to reflect the fact that everyone else who's buying it is already, suffering from several chronic conditions or known to be a terrible driver. So that's why it's a real problem when these products get driven out of existence by selection problems.
Yeah, it makes it so the least healthy among us just can't get insurance. I mean, they just can't because that pool is so dirty. Yeah,
in the case of Harvard, you couldn't get the more comprehensive coverage. You could get a more minimalist coverage, but again, even if you're healthy, some people will value the security of knowing that should they get sick, they have a very comprehensive policy that will fully protect them, and that became unavailable.
Yeah, you won't be able to get it anymore. You don't write about this in the book, but I want to extrapolate two areas of financial planning just based on what you've said so far that seem to make sense to me. I have read, disability policies, if you're going to buy them on your own, Amy, are very expensive. And I would have to believe this is selection at work. The only people who buy long-term disability coverage, or maybe an outsized portion of people who buy long-term disability coverage, are people that know that something might happen to them, or they know inside that they have a better chance of the risk. Would you say that's got to be true? That's why it's expensive?
Absolutely. One of the challenges in doing research on this topic and writing a book on it is that many of the markets where adverse selection wreaks such havoc become incredibly small or completely go out of existence as a result. So the disability insurance market is quite small. Others go out of existence, and it's hard to study. Sometimes it's even hard to think about what are the markets that don't exist because they're not in front of you. So we actually, as we talk about in the book, did what all serious research economists do and conducted a Twitter poll of, what are, of our fellow economists, of what are some of the kinds of insurance products that don't, exist. Also we could have done, as you said, ones that are very small, like disability insurance, but we were going, even more so for the ones that would be valuable but don't exist. And we got some, not so serious answers like first date insurance or, 10-year denial insurance. Right. But one of our favorite examples, and then we actually were able to learn something about the history of this non-market, is someone pointed out that you can't buy insurance against divorce. And then, of course, they caveated quickly that, they weren't looking for themselves, but just saying, there hadn't been divorce insurance. And so we actually looked into it. And this was an example of someone who tried to start a market for divorce insurance back in I think 2010. The market's, enormous. And there are well over 2 million marriages a year. And the problem is kind of obvious, right? Who are the couples who are, going to want to buy divorce insurance? They're ones who are worried that, they're about to, their marriage isn't going so well and they may be headed for an expensive divorce. Now, the entrepreneur, John Logan, who started this business, wasn't fully unaware of this selection problem. He understood that divorce insurance and broccoli were different. And so he put a 4-year waiting period on the policy, right? So if you buy a policy and you divorce within the first 4 years of the policy, you're not going to get any payout. So the idea is, well, that's going to hopefully ward off, the customers who are already at each other's throats. But unfortunately, this wasn't sufficient. The market did not survive. The policies were incredibly expensive, priced, basically because they're expecting that even with this waiting period, the people who are going to buy it are people who are likely to get divorced. And, it turned out to be worth less than just putting your money in a savings account. And that has the added advantage that if you don't get divorced, then you still have that money. So yeah, it was a really bad idea. Similarly, private insurance against layoffs. We talk about in the book suffered a very similar fate, right? That it also, several entrepreneurs tried to offer it. They put in waiting periods, and yet the market just totally collapsed.
I found that case study that you go through on layoffs particularly interesting because this idea of waiting periods, and I want to get back to this in a second, Amy, because I think this is why it's important for people to read the fine print and understand what they're actually getting into, because these waiting periods are designed, according to you, to make sure that they, don't attract the wrong customers. The waiting period makes it better for you as somebody holding insurance because you know that you're weeding out people that already know they're going to want to use it. But in the case of layoffs, those waiting periods weren't long enough. Like you wrote that they had a waiting period of 6 months. And in some of the stories that you tell, people are like, yeah, there was no writing on the wall a year, ahead of time, but you just kind of knew. It just felt like we were going the wrong way. So you were only going to buy that policy if you thought something bad was going to happen. Yeah,
no, exactly. So waiting periods are one of the quote unquote solutions to selection problems. I say quote unquote because they come at a cost. That means you don't actually have insurance during the waiting period. And some people, may actually just unfortunately get laid off in the first 6 months after they bought a policy, not because they knew it was going to happen. It's the actual risk. But the flip side is what you're trying to do is prevent people from waiting until the risk has occurred to buy the policies. Like one of the central, messages you could take away from our book is, as I said, the whole point of insurance is to smooth risk, to get rid of vagaries and vicissitudes. Therefore, you can't wait to buy the policy till the risk has occurred. And, I can poke a little fun at my husband, as we do in the book, as an example of someone who, at least when he was in graduate school, hadn't learned this lesson. He had AAA towing insurance. But he lived about 50 miles from his childhood home, and they had a beloved, childhood mechanic in his hometown that they thought, did a great job. And he always thought if he ever had serious serious car problems, he'd take it to the hometown mechanic. Well, one day his car broke down, and he had, he's a grad student. He had the bare bones cheap AAA policy that only will tow you within 10 miles. Ever the resourceful guy, he calls his AAA policy from the side of the road, from the side of the road where his car's broken down, and says, "Hey, I'd like to upgrade to the deluxe policy that can tow for up to 100 miles." And they very accommodatingly said, "Sure thing, sir," and that'll go into effect, in another month, right?
Like, no. Yeah, I want it right now.
Yeah, well, and there's a reason he couldn't get it. So he's like the customer that the company doesn't want. He's a bad insurance customer. He's a very good husband, I will say, but I wouldn't sell him. I wouldn't try to sell him insurance. But the point is both that's why they have the waiting periods, but also buying and trying to buy quote unquote insurance after the bad event has occurred. That's not insurance, right? The whole point is to buy it before, when there's just a risk.
Well, and that's interesting too. And you make that note right away that when you're buying insurance, you want to do it as early on as possible, because that's your best chance of having more information than the insurance company will have about you. Over time, they'll get more about you. But this also applies to, I was thinking as I was reading, Amy, about, suicide exclusions the first 2 years on most. And I think all life insurance policies, a suicide exclusion is also, I would guess, a waiting period.
Exactly.
In a way.
I mean, another waiting period is if you've ever wondered why you're only allowed to change your health insurance typically once a year in the fall, right? That's another example, right? They don't want you to wait until you discover a lump in your arm to upgrade your health insurance policy.
Why do they want to give you a discount if you have a gym membership?
Yeah, that's one of my favorite examples. Especially because it turns out to be true. Like, I thought it was just apocryphal when we started working on this book. So health insurance companies will sometimes offer discounts to gym memberships if you sign up with them.
Right.
Now, you might think that that's because the health insurance company is hoping that you're going to go to the gym, use it, be healthier, and cost them less.
That's exactly what I thought.
Well, you'd be incorrect, but you'd be in good company. That's what I think a lot of people think. It turns out, and we have work by the researchers Cooper and Trivedi that show this, is that what happens when you offer gym memberships is that you attract healthier customers. So a gym membership is not going to be appealing to someone who, is suffering from multiple chronic conditions and is basically homebound, couchbound, has trouble walking, etc. It's going to be appealing to the healthier among us who can at least delude ourselves into thinking, boy, we'd use that gym membership a lot if we got it. And that's precisely what they find. They find that it attracts people who are already healthier as their customers. And separately, we have really cool work from a randomized trial that 3 economists did. This is Damon Jones, Julian Reif, and David Molitor, where they actually looked at randomly offering some workers at their university, at the University of Urbana-Champaign at Illinois, offering them, workplace wellness programs, and then followed and saw what happened to their health, their absenteeism, etc. And they confirmed, what is unfortunately true, which is, workplace wellness programs don't actually make workers healthier or more productive or less prone to absenteeism. But what they do is appeal to workers who are healthier. The ones who signed up for it were the ones who were, at baseline already in better health. And again, it's that selection. We're doing it not to change, how healthy people are, but to make sure we select or get the healthy customers.
That's interesting. Well, yeah. And if I'm an employer and I offer that type of program, I might also entice those people to want to come work for me. Healthier people's going to show up, maybe work more hours, be a clearer head. That's incredible. I want to go next to just a couple things before we say goodbye. This idea of insurance, though, still, Amy, seems very, very I'm not going to say easy because you just talked about how it's not easy, but it still seems fairly simple. I put a bunch of people in a pool. I try to make sure that pool is as healthy or as not going to use it-ish as possible so that I protect the integrity of the pool. And then I pay out to people that have an occurrence, and the rest of the people, get the peace of mind that if something happens to them, that it's okay. Why do insurance companies have, by far, you write, this really surprised me, the biggest lobby in Washington? It doesn't seem like there would need to be that big a lobby in Washington if this is just a cut and dry game of find your customer and learn more about them.
That's a great question. I think the reason is because insurance isn't just big business. It's big government, right? Government is incredibly involved in all kinds of insurance markets. Think, for example, unemployment insurance, disability insurance, which you mentioned before, regulation of health insurance markets. There's a Treasury official recently had a great quote. He said, the modern government, you can think about it as a, large insurer with a small army on the side or something like that. I mean, a lot of what government does these days is get involved in insurance markets, either directly providing it in the case of, say, unemployment insurance and disability insurance, or regulating the market in the case of health insurance, also auto insurance, even life insurance. And the reason the government is so involved, and that's why I'm going to surmise the reason there's so many lobbyists, because once the government's involved, the lobbyists want to be involved. The reason they're so involved is precisely because these are not markets. Insurance markets are not markets that can work well on their own, precisely because of the selection problem. This is why we sometimes need, government's helping hand to make the market function in the same way that governments, regulate monopolies and banks to prevent bank runs and polluting firms and the like. Now, that doesn't mean they always get it right or do it well, but that's at least why they're involved.
What should our big takeaway be if I'm just the average consumer out there listening to you and I talk right now?
I would say two things. First, don't be like my husband. In a specific sense, buy insurance before you need it, right? Insurance is about risk. And especially if you think, well, you're low risk. That's in some sense when insurance is most important. It's for the things you aren't expecting, but could be potentially catastrophic, like, your house suffering huge damages. But the second thing is be aware of selection and be aware that a lot of these products are going to be priced, assuming that the people who are buying them are actually high cost, high risk. One tip I have is, in the same way you mentioned earlier about waiting periods and how they can they can help an insurer attract lower cost customers. That means they can be lower priced. So you may be willing to tolerate getting an insurance product with a long waiting period or a big deductible. The bigger a deductible you are willing to live with on your automobile insurance or your homeowner's insurance policy, the better deal that product is likely to be, because it's likely to attract the lower cost customers.
I don't know if it's bad for me to admit this, but I guess I'm going to help your husband out a little bit here, Amy. I will admit that on a roadside once near a convenience store where I'd locked my keys in my car, I called OnStar and tried to sign up on the spot.
Oh, wow. I guess I didn't realize this is a general problem of male behavior. Well, yeah. I will say also, going back to my plea or pitch that you should get high deductible insurance if you can. When we bought our first house, I searched high and low for the highest homeowner's deductible known to man. Mostly you can get a $500 or a $1,000 deductible. I actually found a $10,000 deductible policy, which, given how expensive a house is, it seemed worth it because the premiums were a lot lower. Now, shortly after we bought our house and that policy, there was that huge winter of 2015 in Boston where I live, where the ice dams and the snowstorms, and we completely blew through the deductible that year.
Oh.
Then the following year, we had a huge flood in our basement, also blew through the deductible, prompted my long-suffering husband to remark that it sure was expensive being married to an insurance expert. But even he will admit that if you look back over all the years we've had the policy now, even with those two years of quite high and unfortunate home damages due to the weather and due to a faulty leak in our water system, we've still saved money because the premiums are just so much lower. And really, the point of insurance is to protect against the catastrophic loss, which fortunately we have not had yet. But were we to have it, that's what we want financial protection against, not the small bore, although admittedly quite expensive stuff that comes under our deductible.
The book is called Risky Business, Why Insurance Markets Fail and What to Do About It. If you are like most Americans and you just find insurance to be a bleak and just this fog of mystery, Amy, you and your co-authors, you guys do such a great job here. I love the stories.
Thank you.
It's just a great way to learn about insurance. This is available tomorrow everywhere, right?
Yes. Yes.
Awesome. Well, thanks so much for helping our stackers get literate on insurance. I appreciate it.
Thank you so much for having me on the show.